The single biggest story in the market isn't being fully discussed. AI is bigger than most people realize, not just as technology, software, or stocks. AI is reshaping the entire financial system. And while the herd chases the flashy surface layer, the deeper current is flowing somewhere else. The real story isn't AI, it's the money powering AI. And that current still points towards bonds. Hello, my name is Daniel Young, and this is Adaptive Perspective. Every week, we separate currents from noise and opportunity from fear using an income focused strategy in closed end funds. This isn't polished, it isn't scripted, and it's definitely not herd thinking. We don't chase headlines, we navigate markets. Now, let me be clear, I'm not a financial advisor or a fiduciary. I am an income hunter, a strategist who filters the noise, follows the data, and targets durable cash flow, even when that means taking a different course. So let's step into this week's waters and see what's actually moving. Let's frame AI in a structure we can all understand. At the foundation of the technology family tree are two parents, hardware and software. Every modern technological advancement is built from some combination of those two branches. Every generation improves upon the generation before it, and occasionally we experience seismic advancements. The internet was one of those major evolutionary leaps. When the World Wide Web entered public life in 1991, it didn't replace existing technology, it reorganized society around it. Entire industries formed around the internet, others disappeared because of it. AI is the next evolutionary leap. It's not a replacement for the internet, but a dominant new branch growing out of the existing system. AI still depends on the rest of the family tree: hardware, software, the internet, data centers, communication networks, energy infrastructure, and financing. That's why the full picture is so difficult to see at once. Most people are only looking at the visible consumer layer, the chatbots, the software tools, the stock prices, the headlines. But AI is much larger than the surface products people interact with. We are watching the opening stage of a new economic age. And like every transition between ages, the overlap period creates confusion. Old systems still exist while the new system expands through them. That's why so many investors are struggling to properly frame what's happening right now. They're treating AI like a sector, but AI isn't merely a sector. It's becoming an infrastructure layer that touches every sector. The distinction matters because once you understand AI as infrastructure instead of hype, the financial picture changes completely and forces us to seek answers to important questions like who finances the expansion, who powers the infrastructure, who benefits from lower rates, and where does the money actually flow underneath the surface? Because that's where the deeper financial currents exist. Here's the story everyone sees and the story they're missing. Every company is using AI now. Every industry, every sector, every business, even small businesses. And the larger the company, the larger the AI investment. And the smaller the company, the larger the efficiency gains. AI is restructuring everything: workflows, marketing, labor, and competition. And most people still think AI is just a chatbot. That's how early we still are. We're less than 10% maybe into the age of AI, and most adults still frame it like a novelty. But it's not a trend. It isn't a TikTok cycle. It isn't just another technology phase. AI is a full scale economic shift. It's a financial current powerful enough to carve through entire industries. Meta showed everyone the blueprint. They didn't necessarily fire people, they simply stopped hiring. They redirected the savings into expansion and development. That's the future. AI isn't replacing jobs, it's rendering some jobs obsolete while forcing competition into stagnant sectors. If AI can do the work of a $100,000 marketing contract, companies will use it. If AI can replace repetitive administrative work or lower operational costs, companies will use it. That's not emotional, that's economic reality. And yet, most discussions around AI still revolve around stock prices and headlines and chatbots. That's because the herd focuses on what it can easily see and understand, the flashy layer, the visible reflection. But reflections aren't currents. There are several reasons the full AI picture isn't being discussed. First, AI is still new. Most people are only discussing the obvious surface level applications. Second, most can't categorize it. I haven't seen that AI family tree hierarchy anywhere. I made it for this video. In the news, AI overlaps software, hardware, infrastructure, energy, data, security, communications, labor, finance, etc., etc., etc. It touches everything, directly and indirectly. Third, inflation is an easier narrative. The herd already understands inflation, and the media understands how to sell inflation fear. Fear generates clicks that generate engagement and keeps people emotionally locked into the news cycle. And lastly, or fourth, the market itself is struggling to properly price the long term implications because AI is not just a stock story, it's a macroeconomic shift because the inflation story isn't what people think. So let's slow down and think logically. Inflation happens when the dollar becomes worth less. That's the simplified version. During the pandemic, the Federal Reserve printed enormous amounts of money in a short time through quantitative easing and created inflation. Side note, when my elementary age child understood that increasing currency supply reduces purchasing power, and Jerome Too Late Powell couldn't publicly admit that, he's not the fixer. He's the epicenter of the problem. Getting back, once the Fed created inflation, they were allowed to solve its own problem, something you won't see anywhere else outside of government. The Fed's solution is and has been quantitative tightening, higher rates, tighter liquidity, less spending. We're still there. So here's the question. If we're in a quantitative tightening environment and the government isn't flooding the system with stimulus money anymore, where's the current inflation pressure actually coming from? The answer? Perception. More specifically, energized fear. The United States is energy independent. We are producing enormous amounts of oil and liquid natural gas. We are expanding refining capacity, and we are exporting energy. And because of the Iran conflict, Iran has inadvertently made us the world's export hub. Certainly not their goal. But the herd hasn't heard that. They only hear what the headlines blast. War, Iran, Hormuz, OPEC, shipping lanes, and they panic. Their fear drives prices higher. And that increase in energy prices filters through transportation, manufacturing, food, logistics, and services. That creates trickle down inflation. Or, in other words, part of the inflation people are experiencing right now is fear driven inflation. Nothing fundamentally broke inside America's supply chain. The perception changed, and perception moves markets. That's why I believe when the Iran conflict fully settles, oil prices will likely fall hard. The White House's Economic Council is reading the same tea leaves. When energy prices drop, costs across the board should begin easing with them. And now this is where the story gets even more interesting. At the same time, energy fear is temporarily pushing prices higher. AI is doing the opposite. AI is structurally deflationary. It lowers labor cost, increases efficiency, speeds up production, improves logistics, reduces operational friction, increases competition. That matters. And now we have a new Federal Reserve chair openly discussing lower rates, data driven policy, and the deflationary impact of AI. That's important because AI doesn't just need innovation, AI needs financing, and financing flows through debt markets. That's the part almost no one's talking about. And if they did, the bond bull wouldn't be hiding in plain sight. It's hiding because reflections are easy to see and currents are harder to find. The herd sees AI and immediately runs toward tech stocks. That's understandable. The surface layer is obvious. But the real money powering AI sits underneath the surface. AI infrastructure requires energy, cooling, data centers, grid expansion, oil, natural gas, debt financing. All of that costs enormous amounts of money. The AI race is becoming the next global arms race, and successful arms races are financed. That's why bonds remain the lead current. The flashy AI layer gets attention. The financing layer powers the expansion. That's the hidden bond bull. And once rates begin moving lower, that current strengthens further. That's why the primary financial currents remain. It's been this way for weeks, months, maybe a year or more. Bonds and select bond proxies, real estate, end-to-end energy, technology, software, AI, infrastructure, that technology family tree, right? Just beyond the large caps. Not because the other sectors are irrelevant, but because these are the sectors most aligned with the macroeconomic direction of the market. And here's how closed-end funds fit into the mix. I prefer closed-end funds over ETFs or single market investments or really anything else that's out there. With ETFs, you're generally paying full price. Very small, or sorry, you're generally paying full price. And sometimes you're paying hype prices. And while you wait, most broad ETFs pay very small dividends. The average S&P yield is barely above 1%. That means you're relying primarily on future price appreciation. And price appreciation doesn't become real until you sell. That works for some people, but it's not the system I want. The income radar framework focuses on something different. We identify actively flowing financial currents. Then we screen for funds positioned inside those currents. And we prioritize historical valuation opportunities, discounted pricing, monthly dividends, strong income, and sector positioning. Closed-end funds allow us to buy systems of assets, often at discounts, while getting paid to hold them. And that changes the equation. Instead of waiting years hoping the price eventually rises, the portfolio itself produces ongoing cash flow while the market moves. And yes, price matters, but consistent income matters too. That's the difference. The goal is to build a portfolio that eventually supports itself through income generation instead of slowly liquidating itself through withdrawals. Some funds are long term holds, some rotate with the currents, some funds carry sell signals based on pricing or market changes, but the core principle stays the same. Find the current, position inside it, let the market do the heavy lifting, and get paid while it pulls you forward. Now, with all of the aforementioned material as reference, let's move into this week's closed-end fund snapshot and look at the funds aligned with the strongest flowing currents. Let me share my screen. And it's currently, I want to say it's a 9-pack. Yes, it is a 9-pack right now. And I left it this way for a reason. I'm not sifting the entire full list, but I did want to sift it a little bit with you. So this is a mix of real estate at the top and bottom. Uh, the double line funds are bond funds, but they're really bond nuance funds versus PIMCO is really just a bond fund with, I guess, some nuances embedded. HGLB has a small allocation of bonds, but it really hits on the other tiers of currents. So it's you're looking at bonds, real estate, end-to-end energy, and tech. And HGLB has some bonds, energy, or real estate, energy, and tech. And I'll come back to that. BRW is an income vehicle. It used to be a bond hedge fund, and has since just moved into anything and everything that might be income generating. Plus, they're a shareholder advocate, and I really like the fund. I like their methodology. So, of the options, HGLB is the easiest one for me to get off the list because they're invested where I would like to be invested. They're still over, from my standpoint, with 30% of the portfolio still in mid-wave wireless. I think mid-wave wireless it'll be a bigger thing than we all expect, but at the same time, we're still waiting for that to happen. At the same time, HGLB used to be a very almost its own product specialist, where it was invested in uh, bonds, real estate, uh, really everything that's posted, but it's also become more of a portfolio in a can where it's hitting every single sector, including retail. And I'm not a huge fan of overall consumer retail. Um, but the more questionable end of their recent acquired funds is Fermi. I, I like the idea of Fermi, um, a data center conglomerate, almost like an umbrella corporation where Fermi's the umbrella and they house other products underneath. The problem is Fermi debuted high and it's since come down, which I guess that's most companies. But they also, as of last reports, they have not found anyone to shelter under their umbrella. And 4% investment isn't huge compared to a 30% plus investment, but 4% will still drag their portfolio. And if Fermi fails, as much as I don't want it to, if Fermi fails, it is going to drag down the overall net asset value of their portfolio. And as crazy as it sounds, if that were to happen and the portfolio uh, asset value drops, that's the time to buy it. It's not a bad deal right now. There's just too much on my end. There's too much risk with Fermi not having a client. So that leaves us with this, and I would rank it like I would rank it as follows. I would pick bonds. I mean, bonds are the primary flowing current. It's hard to look outside of bonds. So that's those guys. If you're trying to differentiate between Jeffrey Gundlach at Double Line and Dan Iveson at PIMCO, they're doing very nuanced things under the bond umbrella, and their funds just outperform the market. It's a close shave between them. They're really equal. PIMCO has a lot more funds, um, but I like them both equally. Um, I think the private credit market is weighing a little bit, really, on all of our portfolios, but especially double line because they do dabble in that collateralized loan obligation. And the private credit market fears do seem to be overblown. Apparently, there was one report that referenced risk in the private credit market. And then we have that massive sell-off and the rumblings that are still going on. But the more I read, the more I see that, or the more I read of people invested in that market, uh, the fears seem to be overblown. That's not to say they don't exist. I mean, the herd causes panic, right? And then fear sells. Um, so it lingers, but it still seems to be overblown. So on my end, and how this system is structured, DSL doesn't make the list because the discount is historically significant this week. It makes the list because it's a dollar cost average move for me. Last week, and I didn't buy last week because my week was crazy. Last week, this would have been what I bought, but I didn't buy it because the week started. Man, the week started crazy and ended crazy. So I'm a stickler to my rules. I don't advertise one thing and then do something different. So DSL makes the dollar cost list, but it doesn't make the general buy list. IGR is a dollar cost thing for me. It still seems like a great global real estate portfolio, but it doesn't hit the overall target based on a significant discount. So pending your take of that, I mean DSL is a great dollar cost average move for me. IGR is the same way. But if I was buying them, looking to buy them in the Roth, they wouldn't make the list because I'm a stickler to that triple asterisk. So it leaves us with this. It's your portfolio position in the greater market. It's your belief or your belief and ideology based on currently or existing currently flowing currents. Just sounds pretty redundant, but we'll say flowing financial currents, right? And then where the market would go. I would do in order bonds, real estate, end to end energy, and then that technology family tree. So bonds are first, real estate is second. BRW as an income vehicle fits somewhere into the real estate area. Um, it's not. It used to be a hedge fund, but now it's bonds and a lot of other stuff. But it's primarily a lot of other stuff. But I'll include it in that second tier, and then you have end to end energy and technology family tree. So that means I would prioritize here and then look outside of it. Now, the other factor is, well, two factors, I guess, would be the money you have on hand and your comfort level. Money on hand, like if that's all the money I have, then it's not like I can buy everything, right? Like if you were going to invest 30 grand in the market, well, you can buy really whatever you darn well choose, right? But at 6 grand, it's not like I can buy everything on the list exactly like I want it. I like packs of 100. Makes the data easy. It creates a better dollar cost average pattern over time. 50 is okay, but I really like 100. It's just I got into that habit. Um, so at $6,200 across 9 funds, that's really not that much money across 9 funds. So if we're going to be choosy, I mean, we can be hyper selective in a lot of different ways. So the market's not open tomorrow. There's still plenty of time to consider what we would do Tuesday if we were buying Tuesday. Um, but based on this data, this is the way I would sort it today. If we're going to prioritize bonds, IGR would not make the cut. It's tempting as a dollar cost move, but it wouldn't make the cut. And RFI is also tempting. It's a little higher than our current buy-in price. Yes, it's got less than a 9% dividend, but it's just a great, gosh, it's a great consistent payer. But and I'll even go back to IGR. So with IGR being a global real estate group and with RFI being more of a North American real estate group, so if the US does indeed lower rates, that's one contingency or one category of their portfolio. That's not everything. It's not like we're going to see lower rates across the world if the US lowers rates. So even though I think real estate is due for a resurgence or recovery, and even though I would love to buy however much of it I wanted, it's really hard to look past bonds. So if I drop IGR and I drop RFI, BRW, I don't know, I'm 50-50 on. It's by far my largest current portfolio holding at 2,000 shares, which in the grand scheme of things is not much, but based on my existing portfolio, it is. My hesitancy is their rumored merger with the other end of their uh, Saba Capital. So there's BRW, and now there's also SABA. Since the rights offering, BRW prices slid a little bit. Not a big deal to me. But if they do in fact merge with Saba, I don't know where that shape or like how that influences the company, and I think that also plays into the current pricing of it as well. So at 2,000 and my uncertainty on how the merger works and if it's really going to happen, I would take it off the list. And that leaves me with just bonds. It leaves me with PIMCO and double line. And that's really on my end of things, it makes the choice easy. So to calculate this total investment, if you've never done this, you equal whatever your starting amount is minus the sum of these cells gives you a total. And as we change the spreadsheet, you're left with whatever you have left. So I could pick up a 100 pack of all of these and have money left over. If I really wanted to, I could pick up 200 there and still have money left over. And as to what it would do with my monthly dividends, it would increase it by about $56. And then annually, we could look at that too, 683, but really that's what I'm tracking month to month. So that's the final five for the week, all bonds. If I had more money, or if I thought I had a better opportunity in RFI, BRW, or IGR, then yes, they could pull back on the list. But with bonds being the main financial current, it's really hard to look past it. So that's my five pack, and I will stop it there. So I'll leave you with this. The herd keeps chasing reflections, the next headline, the next hot stock, the next emotional narrative. But AI is much bigger than a stock trade. It's reshaping everything: labor, energy, infrastructure, financing, competition, productivity, and it will eventually reshape monetary policy itself. That's why we don't simply chase the flashy surface layer. We target the deeper current beneath it. Look, if tech stocks were an emoji, they'd be a neon sign, like the obvious pick me, right? And while the neon sign does get your attention because it's supposed to, the bigger story is the power behind the neon sign keeping the sign lit. And that power cord still connects back to bonds. So take your pick. Chase reflections in yesterday's market or position yourself inside the active currents moving into tomorrow. You already know my choice. Now you need to decide yours. So that's it for the market analysis for the week. Though I do have one more thing to add. Memorial Day is Monday. It's if you're confused about the holiday, it's a day to mourn and honor military personnel who died while serving in the United States Armed Forces. And this is my advice to you: recognize their sacrifice and honor it. And then please take some time and thank the veterans you know and any you randomly meet. Honor our military and those who dedicate their lives to implementing war on our behalf. It's important. It's not a political thing. It's called being thankful and grateful. And it's called honor and respect. You're recognizing and honoring the service and sacrifice of our military and their families to defend this nation and everyone in it. Whether you like them or not, whether you agree with it or not, it's not about you. It's way bigger than you. It's way bigger than me. Those men and women are out there learning, improving, and fighting for us, and they do it willingly. They deserve dignity, respect, and acknowledgement. They deserve a thank you, a handshake, and a smile. So I wish you all a freedom filled Memorial Day, courtesy of our amazing military and their amazing families. I hope you get to spend the day with family and friends, and I wish you a successful week. Whatever you have for the week, I hope it goes well. I hope you make progress on whatever you have in front of you. And I look forward to seeing you next Sunday. So have a great week, everybody. I wish you well. Catch you on another video. Bye bye.